Let's get clear what we mean by slowing prices first of all. You see, with momentum indicators, what we're in part talking about when we say a leading indicator is something which of course tells us that the prices are about to turn. Well, how can you tell a price is about to turn? Now you've got to imagine that every trader, and a lot of them use momentum indicators, every trader who uses momentum indicators understands them and how they're constructed in a far greater level of detail than the private investors who just think, oh yeah, I read something about the MACD or the RSI and I want to just know what the rules are. That's why we're going to go into a bit of back history, as it were, about how they work. Because when you understand that, then you can trade better, because then you can understand when they work, why they work, how they work, and when they don't work. And those things are essential. I mean, imagine if you're a plumber, and I said to you, oh, here's a toolbox. Don't worry about how all those tools work. Just take them with you to work. You see what I mean? We're trying to be more professional. If we're going to be professional, we need to know how the tools work so we can understand them. And all of that is valuable education, because it will help us either save money, make money, or save time. And those are the three things it's all about. So what do I mean by slowing prices? What momentum indicators do is they tell us when the price is about to slow. That's when we're talking about a price which has been going up and then is about to turn. Of course, if we're talking about a price which has been falling and then about to turn, again, they're still telling us about slowing prices. What we mean by slowing prices is a potential turning point, i.e. something losing momentum. If something is going up and up and up, shooting up, and it's slowing down, whatever that thing is, it might be a ball thrown in the air, whatever, then we're talking about it slowing. Now, this is where it all ties in with what we see in the physical universe, as it were, with slowing prices. What these mathematicians who looked at daily prices like these said is, you know what? Imagine if all these share prices were like any other physical object. I mean, share prices go up and down, up and down, up and down. Well, wait a minute. Throw a ball in the air. Sure, we're talking about momentum. Throw a ball in the air. That also goes up, and then it slows down, stops, and then speeds up and falls back down to earth. Well, if prices seem to do the same, which is go up and go down, then how can we mathematically, because we can mathematically create a formula for this, which is the parabola that a ball makes as it accelerates, as it's rising higher and higher, slows down, then at this point stops before momentarily going faster and turning back down. If we can get a mathematical formula for that, why can't we do it with share prices on the basis that they also seem to go up and up and up, slow down, stop, and then turn round? Now, of course, there's a lot of assumptions and presumptions we're making in that. Let me explain what they then said. They said, well, okay, how would you define what slowing down for prices is so that you can anticipate when the price is about to turn and move in the other direction? Because with a ball, it's easy. How do you determine that a ball is slowing down? Well, you monitor its velocity, and the speed at which it's traveling, and its acceleration, and you get an idea that, first of all, in terms of velocity, it's going slower and slower and slower, with acceleration that it's similarly decelerating, and then there's a point at which it stops, i.e. its velocity is zero. Well, what's the equivalent with share prices? And then what they did is they looked through thousands of these bar charts, and they said, you know what, when a share is rising, i.e. it's got momentum, and people are getting into it, it tends to, but not always, tends to close near the high for the day. The closing price of the share tends to be near the high, obviously not always, look at that, but otherwise it tends to be quite near the high, if that's the high. And they said, well, when it's slowing down and about to turn, what tends to happen is that the share price closes not near the high for the day, that's the high, but tends to close more near the low. That was the high, this is the low. That was the high, tends to close more near the low. Not quite there, but here, there. Why might that be? Well, there's an obvious reason for that. Think about it. If a share's got momentum and people want to put money into it and they want to buy into it, they like the story, they think it's a great stock. Well, during a trading range in a day, whenever the share price, whatever it's doing like this, it should close near the high for the day, because if you've got momentum and it's going to rise, well, buyers are willing to get in. Why would it close near the low? Why would it trade as high as this and then sellers come in and push it lower down? They wouldn't. It doesn't make sense. So if you're looking at something which has been trading along this kind of price range from high up here during a day to a low here, of course if it's got momentum, it should close near the high, because the buyers would have come in here, they came 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 in here, and so forth, and the sellers never got the opportunity to sell and push the share price lower. So they said, well, of course it makes sense. It makes perfect sense. If a share's got momentum, it should close near the high of its day. Now, mathematically, what if we can monitor that to say, well, yes, it's had a tendency to close near the high for the day, and then relative to what it was doing, it's not closing near the high. So what they did is they created a mathematical formula which then depicted that in a graphical form. Now the great thing is this gets really easy for us, because what it means is all we've got to do is look at some pictures rather than looking at each one of these. We don't obviously have to look at each bar and say, oh, is it closing near the high, isn't it, is it? I mean, how difficult would that be? Instead, what we do is we look at these other indicators which we're going to go through, and we say, okay, they're showing certain patterns. When those patterns exist, we know that the share price has a tendency on 7 times out of 10 to move lower or move higher, whatever the case may be. So we just need to know what the rules of interpretation are. Then we finesse them through using the input of numerous real-life traders. So basically, what these boffins did is they looked at a lot of share prices, they took their inspiration from what happens in real life, they looked at a lot of share prices, created some mathematical formula, then graphically depicted them. So we only have to do the easy thing, which is to look for certain patterns. When those patterns occur, we know that 7 times out of 10 in the past they've led to a share price moving, therefore we induce, or we deduce, that they're going to lead to a share price move lower. And you might think, well, wait a minute, isn't this a bit magical? Isn't it a bit of a leap of faith? Well, no, because remember what it's grounded upon. Grounded upon where buyers, real people out there in the real world, are putting their money where their mouth is. Now if they're willing to do that, that of course incorporates fundamentals. It incorporates PE ratios and news which has come in the market. Why does it? Well, because these people who are putting their money where their mouth is and taking the price to where it should be are doing it based upon all the other market information. And that's why momentum indicators and technical analysis is so wonderful, because what it's saying is, look, you take the fundamental stuff, you traders with the money, then take your money, put it into a certain stock, and we'll look at your outcomes. So we already incorporate through your actions going backwards the fundamentals, so we don't need to look at them, because we only want to see you put your money where your mouth is and look at what your outcome is. We don't want to look at all the inputs, we only want to look at the outputs, i.e. we'll judge you by what you do, not by what you say, not by what you read, and that's the beauty of it. We can then look at an image, a picture, and quickly grasp whether or not we've got slowing prices and so forth. But this is some of the back history which I wanted to explain in this chapter as to why momentum indicators work and why you can have a certain degree of confidence in them. Next, in the chapters going forward, we'll build upon this knowledge base.